What to expect out of the economy and the stock market in 2025. That's the subject of this week's fastest 4 minutes in finance. Well, it's our first segment of the new year, so it makes sense for us to lean on our partners at LPL Research and get an inside look at what could happen over the next 12 months. The research team recently released Outlook 2025 and titled it Pragmatic Optimism. If we look beneath that headline, we see that the team believes the economy is still on strong footing, but is set to slow down in 2025, and history tells us it will be hard to produce stock market returns on par with what we've gotten over the last couple of years. Let's dive into the economic predictions first. LPL sees consumer spending slowing down and unemployment continuing to tick up in 2025. They also think wealthier consumers may keep consumer spending strong, which could keep the inflation rate steady. That could in turn push the Federal Reserve to be less aggressive in cutting interest rates. On the upside, businesses are signaling that they plan to make more capital expenditures. Well, here's a look at LPL's economic forecast in the numbers for 2025. They are making predictions on GDP, the unemployment rate, different measures of inflation, the Fed funds rate, and the prime borrowing rate. In each category, you can see where we landed in the first 3 quarters of this year, and in the green shading where LPL thinks we will land in the quarters ahead. GDP growth is slowing, but not negative. Unemployment is higher, but still historically low. Inflation and interest rates remain at or below long-term averages. And you won't find the word recession anywhere in their predictions. Of course, these are only predictions. As for the stock market, if the economic predictions are close to reality, it would be hard for stocks to surge on the level of the past 2 years. Corporate profits are rising, but the market has been pricing that in, and history is not on our side here. This chart shows that the third year of a bull market is often positive, but not stellar. The dates in the far left column are the dates of the bottom of a bear market. The next column shows the date of the peak of the subsequent bull market. Then you can see the return of the S&P 500 index in year 1 following the bottom, year 2, and finally year 3. If you see an X in the year 3 column, that means the bull market ended before the end of year 3. There have been 13 bull markets since 1950. 4 of them never finished year 3, and 2 of them produced negative returns. The average S&P 500 return in year 3, 5.2%. compared to 40.2 in year 1 and 14.1 in year 2. Past performance is not a guarantee of future results, and the S&P 500 index cannot be invested into directly. Bottom line is 2025 may not be what 2023 and 2024 were, but that's okay if you have a plan. You should continue to stick to your financial plan, consider equities, long-term investments, and prepare to ride out a short-term rain cloud or even an all-out storm. Thanks for watching. Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.